Thank you, Dave, and good morning, everybody. Price Headley here. Thrilled to be with you to share with you something that's been kind of a revolutionary idea of like combining in options trading. Both we all want high reward, right? But we also want high win rate, and usually it's a trade-off. Usually, when you are going for higher reward, more aggressive options, you're going to have to live with a lower win rate, and still you can do real well with that. But we found an interesting kind of a hybrid, if you will, where you can actually improve your win rate overall. Actually, and our goal is to boost our options buying win rate well past 50%. So that the idea is that you say, oh, win rate 50%, it doesn't sound very good. But a lot of people are used to, hey, 25, 30, 40% win rate in buying options can still make me a lot and make you a lot of money when you have bigger wins compared to your losses. But when we start incrementally boosting our win rate up to win more than we lose, and still getting trades that can turn into multiple 100% winners on the remainder of our position. This is the goal of this whole thing is how do you get to the free trade concept even faster? And that was really the breakthrough that really we want to share with you today, because in the old days, I would say sell half of your position at a double. We can do it even faster now. So I'm going to get into that and share that with you. If you have any questions on the way, do pop them in the chat box. Just a reminder, everything that I share with you in today's presentation is based on our proprietary research here at Big Trends. It's intended for illustrative purposes only and should not be considered specific advisory recommendations here. As you know, stock and options trading have large potential rewards, but they also have large potential risk. The past performance of any trading system or method is not necessarily indicative of its future results. Do see our terms of use on our bigtrends.com homepage for more information here. So, like I said, the goal here is to get your risk capital back faster, get yourself to where even when you're holding a remainder of your position, you cannot lose in the overall trade, even if the other part of your position goes to nothing, right? Because you take your original risk money back into your account on, in this case, a little more than half of your overall position. So we're going to walk you through how that works, that high reward and high win rate. A bunch of success stories. Also, when it doesn't work, what do you do? How do you get rid of the ones that don't get to your first profit target? We call this strategy triple three options, or T30 for short. Triple three for a variety of reasons. We'll get into it here, but basically we want to get to a spot where we can get at least 3 contracts when we get started. And we'll walk you through how these work and how you can get new trades as soon as this afternoon when we have signals. We never force trades. We don't try to fire out a trade every day. We look for quality first, but still plenty of quantity too. If you don't know me, I've been trading options for over 35 years. I caught the trading bug while I was in college at Duke University, and then immediately upon graduating saw the power of options to even further leverage good stock ideas. Then launched bigtrends.com nearly 25 years ago, November 99. So here next in about a month, we're celebrating our full 25th year anniversary. And it's all been about education, right? And it's also been about systems, right? Everybody's talking about AI now, artificial intelligence, computers taking over. I've said all along that computers and having a quantitative definable edge that you can use and easily scan for these. And on our side, we're scanning for them for you with this particular item that I'm sharing with you here. It's an alert service, but of course you can also do it yourself. We have a variety of tools that you can use, but today it's all about kind of keeping it simple. So let's talk about a recent winning trade example and kind of give you the visual. Picture's worth 1,000 of my words. So, and then we got to go to one of the biggest stock out there in the U.S. And the trading world for us on the stock side is Apple, of course, AAPL. And what we're looking at here, I can't give away all the settings here, but I can kind of start to help you visualize the idea, which is that we want to see, first of all, that the stock has just made on that day. This is a daily chart, by the way, in our triple three options setup here. It's made a new high during that day. Now, it doesn't have to close at a high. A lot of people would see this, and I know Steve was just talking about in the prior one, and see this say, oh, that's a bearish engulfing candle, right? And if you're a candlestick follower, you go, ooh, that's a big reversal, that after that big uptrend, it's due to reverse to the downside. And our system is always, just about every system I actually do set up and trade, never puts all of its weight on just one particular bar or candle of action, right? It's an ongoing process, right? So you've got to be careful about thinking I see the obvious bearish engulfing reversal to the downside on Apple there, and I should bet that's going to drop. In this case, our system says actually that it checks the boxes for it's been actually having gaps up and that it's actually made new highs. And so we would actually like to buy a dip in that. We don't require to buy a dip, but once we've made that new high with the other parameters being met, we're buying the last hour of the trading day. So the stock was trading here near 225, okay? So notice what we buy when the stock's trading near 225. This is back on August 22nd. We buy the next Friday's weekly options. So in this case, that following day was going to have the week 4 options expiration. We wouldn't buy them that close to the expiration. We're buying the week 5 options here. We're getting into the 227.5 call. So here, what kind of option do we buy? We're buying at least a week out before expiration. I know that seems aggressive for those who are newer to trading. A lot of the basic options educators will tell you don't buy anything less than 30 days before expiration because they're afraid of you making mistakes as a newer trader. We always guide all of our 333 option subscribers on when to get in, but even more importantly, always guide on when to get out. We send real-time emails, and you can also get smartphone updates. So the idea is that we want to buy an option that's priced at $3.33 or less. That means that each option contract will cost you no more than $333 to control 100 shares of stock. Obviously, you bought 100 shares of Apple here at $225, it costs you $22,500, right? We're going to say, look, we want to buy an option here that costs us effectively $181. Okay, if we said 333, why do we say that? The 333 concept is that don't pay more than 333 because you want to get at least 3 contracts. You don't want to pay more than $333 a piece. That means that for $1,000 per contract, per trade, I should say, $1,000 per trade, we should have that ability to get at least 3 contracts on every single 333 options trade we call out in real time. So that way, you're going to see why it's important to get at least 3 contracts, because we want to sell at least 2/3 of our position at a 50% profit. Why do we do that? Like I said, in the old days, I was targeting a double on half. That's an easy one, right? If you got $1,000 in, you go to $2,000, you take half of your 2,000 back out, your original risk capital back out at a double, and then you try to ride the rest for even bigger gains. Well, here we're targeting to get our risk capital back even sooner to 50% profit target. So that $1.81 went to $2.72. Now in this case, we had 5 contracts. It's not divisible by 3. So we got to get out of a little bit more than 2/3 of our position here. We end up selling, if he's only sold 3 of the 5, that'd only be 60% out. Wouldn't quite get us back to a totally risk-free trade if the other part of our position just totally went to nothing, right? We don't want that to happen, but it can happen. We've got to play for all the possibilities in our trading plan here. So we sold 4 of our 5 contracts at $2.72 at the 50% profit target. So we sold 80% of our position, and you say, oh, why even bother holding that last contract? Well, you can see we got 1 contract left. And by the way, we sold the 80% of our trade. The next day, it reversed back up, tested those old highs up here. Stock rallied about 1%. We made 50%. So we got a 50x type of a leverage ratio here. How is that possible? 50x because we have short-term options that are going to expire in about 6 trading days. So guess what? I feel really good selling it that next day if I can. We're in that prior afternoon, selling it that next day as it rallies back up. And we've got a whole nother week to go until these options expire. So what's our rule on how we hold once we sell our risk capital, it's back in your pocket at 50% gain, 1, 2, 3, 4, 5. Pointer's kind of fritz in there, but basically 5 days, 5-day rule. Give it 5 days to run into the next week, usually not long before the expiration, but we will never hold on the actual expiration day. We'll be out at least the day before the expiration at the latest, which is what was happening here. We were out on August 29th. Those options were going to expire the 5th Friday in August. The week 5 options expired August 30th. So we'll walk you through those rules a little bit more, but we exit kind of midday and just after the midway point of the day, and the stock was trading around 232 when we got out. So we sold that last contract for $5. Remember, we sold the prior 4 contracts for 272. So they've gone on to basically almost double from the initial 272, 50% profit. And you see they've actually almost tripled from our $1.81 entry, 176% gain on that final contract. Think about it this way. If you pay $181 a contract, you take 4 of your contracts out for about a $91 profit each. It's like $364 in profit on the first 80%, the first 4 of your 5 contracts. But look what the last one makes. $500 exit versus $181 in. You made like $319 on just that one solitary remaining contract, right? So you almost made as much on your remainder one contract as you made on the first four contracts profit, right? There's a lot of ways to think about this. You see $683 in gross profit. These examples are all before commissions. And of course, past performance never guarantees future results. I'll show you another example of Apple later. It made even more than this, but it could make less than this, or it could lose the next time we trade Apple, right? We're playing a probability game. So just know I'm not trying to handpick just individual examples. I'll show you the entire performance going back to the beginning of last year to date till now. But basically, let's walk you through some more concepts here. Strategy guidelines. So our average holding period will be a week or less, right? We're going to be in, and we're going to hold it for no more than 5 trading days once we're in. Okay, so the idea is at a week or less. What type of strategy? We're going to buy the next Friday's expiration. It's a price action driven set of rules and setups. And we can make up to 10 new trades a month. I'd say expect about 8 a month, but it could be up to 10. So 8 to 10 a month, about 100 trades a year if you think of it on an annual basis. But it's more important about quality. But like I said at the beginning, win rate goal has improved because think about it. Every time we can get to a free trade, even if the rest of our trade is sold out at a break even or even somewhat of a loss, we're going to make money on that trade once we've sold most of our position out to get to the free trade and see if we can let the rest run. Okay, so we're going to be able to, and I'll show you a bunch of examples where even the other piece turned into a loser, we still made money on the trade. So that's going to help your win rate as an options buyer to improve dramatically versus what you're used to. And that's one of the reasons a lot of people get into options buying. They don't know what they're doing. They lose money and they say, oh, it's a bad game, or it's a game I must be, maybe the sellers are the ones who win. The reality is options and buying and selling is a zero-sum game. There's winners and losers on both sides, buying and selling. You have to just know how you're structuring your trades, whatever you're doing in option strategies. That's from 35 years of options trading experience for me. I've seen it all. You can make money on both sides. You just need to know what you're doing. Now, what we're doing is we're focusing on not just quality, but quantity, right? And what we're looking at is we get a variety of signals, but we put them through this analysis where we look at a 10-year profit factor. What does that mean? It means that a lot of people come in and ask me, well, what's your win rate? And I say, that's not the whole equation, right? Win rate's part of the equation, but also how big we can win versus how small on average we can lose is another important criteria, right? So even if your win rate was, like I said before, was 33%, if you win 10 times the size that you lose, you can make a ton of dough on that type of a setup, right? So we're looking at both of those interplay of factors, not just win rate, but also how big we can win, hopefully how relatively smaller we can lose on average. We're looking for a very positive profit factor compared to the historical averages, looking back over the last decade or sometimes more. Okay, so we're going to get into a trade on an afternoon in the last half hour or so before the trading day ends, Monday through Thursday. Why do we wait for that final half hour or so? Because we're using a daily chart. If it gaps up this morning and then you say, oh, it looks like a big breakout, and then by the end of the day it's flipped and now it's coming back down, your pattern may not be the right pattern, right? So we wait for that end of day to be the proper setup. We can hold up to 4 trades at a time, but typically it'll be maybe 2 trades open at a time, sometimes 3, but 4 is our max. So you're not going to be overcommitted on your trade capital that you're allocating across the service. We will get out of trades after the 5 trading days, and look at our exit point on that 5th trading day in on our runners. Once they've gotten that first profit target, they haven't hit their stop. We get out at 1:30 p.m. Eastern. It's kind of an odd time, but we found that last hour or hour and a half can be a little bit more volatile. So we want to make sure we get you out before some of that end of session volatility. So now, why should you care about this strategy? Again, I show you performance since inception, knowing that I can't guarantee the future, right? Past performance will never guarantee future results. Just keep that in mind. It could be better or it could be worse going forward, right? But the goal is, what I can guarantee is that we're going to follow the system consistently on the signals and the best profit factors taken. You can see that from the beginning of last year through yesterday's close on all closed trades, to been $5,000 accounts grown to over 16,418. So a gross profit before commissions, before subscription investment of $11,418. Now, the beauty of this is it assumes you don't compound, right? That looks like a compounded number. It's not. It's actually allocating no more than $1,000 into each new options recommendation that we make for our 333 options alert service subscribers. So the idea is, look, we're not compounding, we're staying consistent in capital allocation, and it's basically more than tripled on a gross basis. You say, oh, commissions is going to eat it up. Commissions have come down dramatically, right? You shouldn't be paying more than $1 a contract. You have no more ticket charges. As you get more active, you should actually get your costs down even more into the 50 or 60 cent a contract range. So that's something you should look into with your broker if you're paying too much and you're getting more active. So look for a specific setup. These filters are, we're looking for consecutive gaps, back-to-back gaps in the given direction, right? So if we're getting gaps up, we want to be looking for opportunities to say, look, the momentum is to the upside. We're looking at that daily price channel I showed you where we're looking for a new high or a new low to kind of say, yes, that's where you often will get the best trends, right? Not trying to trade within a defined channel, a trading range. That's going to be too slow. We're looking for greater speed of movement. We also use a filter on our bearish put trades when we're buying a put. That's a bearish trade betting on the downside, where we try to also filter out some potential fake out signals with the moving average filter for bear trades. But the key is that it's got to have that history on its side. So we're looking at history on the bull side and history on the bear side, right? So if the history on the bull side is good, but the history on the bear side is not good, that stock's only going to get bull signals. Okay, so we watch that, and when you become a subscriber, we give you the exact settings. So it's not a black box system. You can actually follow along with a rule sheet we'll give you when you get signed up, and I've got a great introductory offer to get you started here in a little bit. But the idea is we don't get in on Fridays. Why do we not only take Monday afternoon through Thursday afternoon potential new signals? Because we don't want to get in on a Friday, hold it 5 days to the next Friday, because that would be the next Friday's expiration day. We want to be out the day before the expiration day. You don't worry about ever missing a signal or accidentally acquiring the stock or any of that noise. It's like, no, we're just in for the option window, and we'll be out before the expiration, at least a day before. We don't take those trades because that would get us out there. So on the expiration, so we avoid that expiration day worry for some people. Don't have to sweat that. So the idea is that, look, we're looking at next Friday. So if I got a signal here today, the idea would be I would be looking at next Friday's expiration, which is actually the third Friday of October. Those are technically called the monthly options, but they trade like weeklies in the final week or so of their life. So we're looking at those next Friday expiration, 333 or less, and we're using what's called the average true range, ATR. Now, I don't need to get too technical here, but basically you take the high-low range, you factor also in any gaps. That's called the average. That's called the true range, and then we average that out over a recent look back of period of time to say, what's a typical range look like? That will tell us how much that stock is expected to move. It's a volatility measure. And then we put in these set and forget stops and targets to make this really ideal, so you don't have to screen watch. That you can really focus on just kind of letting it do its thing. It either gets stopped or it hits its first target level when we get at least 2/3 of our position out at a 50% gain. Okay, so like we said, 333 or less means we're gonna, on every $1,000 allocated, get at least 3 contracts, right? That's important, because to get at least, if you only had 2 contracts, you can only sell one of the 2. That's only 50% of your position. That would mean you'd have to be targeting a double to get 50% of your position out and get all your risk capital back. So 2/3 of our position out at the first target at 50%, or sometimes more than 2/3, like I showed you before. Let's look at an example. So say you bought an option that was priced at $3 or $300 per contract, and you got $1,000 maximum you're going to commit. So you say, okay, I'll buy 3 contracts, $300 a piece, $900 total starting investment. You get the 50% gain, and you sell 2 of your 3 contracts at $450 a piece. That's 50% profit on your 300 a piece. It's okay. Now 2 times 450, 900 back in your account. Again, this is all before commissions. You don't worry about commissions with this setup here. Saying, look, the idea is that, okay, I've gotten 2/3 out. I still have that remainder 1 contract left. That's the proverbial free trade. And the goal here is that don't cut your upside short. Right, I see so many traders that have what I call so much scar tissue, and let me ask you here, how long have you traded options? Type in a number for me. Branded options, type a 0 in your chat box. You traded them for 20 years, type a 20. I like to know, I'm not going to name any names, don't worry. I'm just kind of curious what the experience level is on our crowd of options here today. Is that basically, if you've traded options for any length of time, you're like, man, I was up 20, 30, 40, 50%, and then it came back to break even. It came back to or turned into a loss. So that scar tissue of that ends up making you have a fear of letting your gain slip away. And so what does that make you do? It makes you take your profits too quickly. On the other side, people hold on to their losses and say, oh, it's down on me, but I'll wait till it gets back to break even, then I'll blow it out and just basically kind of stop sweating this one. But that's also not good thinking, because if it's down, it's probably not one of your better ideas, and it's therefore probably going to continue to work against you, and that time is working against you too. So it's like a relatively less experienced crowd today. That's okay. Don't sweat it. The idea is it's incredibly simple to take and put this into actions here. But the idea is that when you're right, give the rest of your trade a chance to turn into something much bigger. That's why we put not just like a next profit target at 100 or 200%. We say, look, we want to give it a chance to turn into something even bigger than that. So here's a first example. And what's interesting about this is it's not just tech stocks that we're trading these options on, right? Everybody would think that tech is where the action is, right? We've heard the NVIDIA stories or Tesla stories or Apple stories. But the idea is that, guess what? Stocks that are non-tech can really surprise to the upside too. Here's one with Philip Morris, the tobacco giant. And you see, we're getting our signal coming into the final hour of the trading day. This is back on July 23rd. Stock trading about 109.5. We're buying a little more than 1% out of the money. We're buying the 111 strike calls into the first Friday in August, which is August 2nd. So this was called out on a Tuesday. So we still have 8 more trading days to go till that August 2nd expiration date, right? We're not going to be in that long, 5 days max, right? But the idea is that, look, okay, obviously these are a lot cheaper, right? So in this case, each of these contracts, based on the typical, average true range, high, low, looking back of how much it can move, we've figured out that, okay, the 111 strike is the one we want to buy, and we're paying 80 cents or $80 to control each 100 shares of stock that would have cost you almost 11 grand. So you're obviously getting like more than 100 to 1 leverage on these options. And we're not targeting to get like the absolute maximum leverage per se, but there is a sweet spot here as we're going from out of the money to at the money to in the money, where we can potentially see these things start to really turn dramatically in our favor as the trend continues. You can see we got 12 contracts. There's a factor of 3, so you're going to be able to get out 2/3 of your position, 8 of your 12 contracts when it hits a 50% gain. If and when, which a lot of these will, not all of them will though, but this one did. You can see the very next day it pops right to the strike price actually. So it goes from out of the money to at the money here, and we're getting our first target profit out because not much time has expired, right? We've only lost 1 day. There's still 7 more days left. And so we've made 50%. We sell 2/3 of our position. You now have the free trade, right? Because you paid $960 on 12 times $80 a piece to control 1,200 shares of stock. And you can see there's more than $125,000 of stock you're controlling for $960, less than $1,000. And then it goes from $80 to $120, and you sell 8 of those at $120. There's your $960 back. You see, at this point, you're saying, okay, now I have the free trade. I have 4 contracts left. Don't get antsy. Don't try to be a hero and try to call the next like short-term top intraday or whatever. Say, give it the 5 days. You have a free trade. What happens if the other 4 contracts go to nothing? Then you're at a break even on your whole position. That's your worst case at that point. Okay. But the idea is that in this case, look, you see your 4 contracts, the stock charges ahead, almost gets to 115, 114.83 is the high. We get out at that 130 point on July 31st, still on a Wednesday, a couple days before the expiration. Those 4 contracts are sold at $340. That's $340. Remember, you only paid $80 a contract. So you're making a profit on those last 4 contracts of $260 a piece times 4 over $1,000 of profit on those last 4 contracts. That's where most of your profit is in this whole trade of $1,360 gross profit. Of course, the profit return has gone from a 50% gain on the first 2/3, the final third, 325% gain. And that's just because you gave it a chance to keep on going, right? You didn't get antsy, you didn't get cold feet, you weren't sweating anymore about the trade, right? We're all kind of sweating that trade at first when we put it on, going, is this going to work or is it not going to work, right? That's natural and normal, right? And that's logical when you have risk capital at stake. But once you get your original risk investment back in your pocket, you should breathe and sleep and trade a lot easier and give it a chance to run. That's the aha. That's the big, and here's the really big one here. We mentioned Apple earlier. Here's one where Apple back in June, everybody's talking about AI, artificial intelligence, right? Well, Apple chimed in with what they called their version of AI, Apple Intelligence, which their new iPhone 16 that just launched is supposed to have in it. We'll see how well it works. But you know what? Wall Street got real excited about it. You can see the stock when we got in had just hit that new high. Yes, it had another one of those bearish engulfing candles. Is that a requirement? No. You see it's about 194. We're buying the 195 calls, less than 1% out of the money. And you can see we're able to get 4 contracts on for $222 a piece. So 222, guess what we're targeting? 50% gain, 333. You can see on 4 contracts, we want to sell 3 of our 4, or 75%. And you only have 1 contract remaining. It sounds so inconsequential, but look at what happens, right? You invest $888. You get 3 contracts out of 333 a piece at the 50% profit target on the first goal and get your risk capital back. You actually get more of it back, right? You've got 111 extra dollars of profit guaranteed in this trade gross before commission. You see 1 contract left, but look at what that 1 contract does. The stock goes all the way up, just rips higher over those next 2 days to $220. We're already selling our first, getting our first profit target like the next morning as that news was announced. We weren't expecting that news to come out, so it's not like there was something that you could expect, but just the system picked it up beautifully. And you can see that last contract at the maximum, it went to about $25. You see by the day 5 exit, we're out at just under 23, $22.95. And you say, oh man, you could have gotten 25. You can't be such a perfectionist. You have to give it a chance. And look at what that last contract did. Remember, on that last contract, we paid $222 for it. It's now worth almost $2,300, $2,295. It's made you more than $2,000, more than a 10-bagger, 933% gain. And that $2,000 makes up the vast majority of your total profit on the position, $2,406 gross profit. You see why you've got to give it a chance to keep going. You can't be so antsy to take all of your trade off and say, hey, you can't get too greedy here. You take the whole thing off at 50%. I'm saying I don't consider it greedy. I consider it good trading to say, you know what? You need those winners because guess what? There's going to be trades that don't work. We're going to talk about one of those in a minute. But let's first talk about the downside that put trades can see success too. Here's a bearish example with Wells Fargo. You see on a number of these, they kind of meet the first criteria that we got to make the new low, and then they flip back up and it closes up kind of in the top 2/3 of the range here. Stock's trading at the end of the day around 43.7. We bought the slightly out of the money 43.5 puts, right? We're betting it's going to go down, so we're betting it's going to get underneath there typically. And the idea is that we're buying those options for 65 cents, $65 a contract, controlling $4,300 worth of stock. We're able to get 15 of those contracts. That's a factor of 3. So we're able to sell 2/3 of our position, targeting the 50% gain. The next day it gaps down here. You can see really nice quick gap on the downside. That gets us more than a 50% gain. It gets us 86% on 2/3 of our position. We've guaranteed ourselves a nice winning trade at that point. But you see, it keeps on dropping, but it's still then it ends up kind of chopping over this next few days, right? It drops for 2 days. At best, we were worth like $1.30, maybe $1.35 to $1.40. But the idea is that, look, we close it out at $1.14, 75% on the last 2/3. We actually made a little bit less on the last third than we did on the first 2/3. That's okay. We still made $805 in profit off of that initial investment. So there's no complaints there and saying, look, we captured that. We weren't sweating it. Not much happened on the remainder of the position, yet still worked out real nicely. So as I said before, the first goal, take 2/3 or sometimes more of the trade off when you get the 50% gain. You get to the risk-free quote free trade concept, you don't have any risk capital at risk anymore. You've got that back in the safety of cash in your trading account. So even if there's a loss on the final third, that trade can generate a profit. Here's a loss on the final third. AMD, Advanced Micro Devices. You see it ripping to the upside. We're not shy about buying into that. If that's what the system says, right? The stock's trading about 179. We're buying the 185 calls into the following Friday's expiration. This was put out on a Monday afternoon, so it still had a lot of time left, and it's part of the reason these were a little bit more out of the money. We paid $325 bucks. So able to get 3 contracts in for $975. Sell 2 of the 3 when it makes the 50% gain, which happens 2 days later as the stock pops up. You can see up to about the strike price here, right? So we're going from out of the money to at the money. Not a requirement, but it often happens that way. And you see, in this case, look, we're targeting now that to let that trade keep running for the next few days. And then by day 5, guess what? It's flipped back down here. So it's about a week left of time in it, right? Or about 4 trading days really after that Monday exit on July 15th. But you can see now the stock's back to about 5 points out of the money. Guess what? Now that's a lower probability that it gets back over 185 by that Friday. So we're actually down 26% on that last contract. And yet, because we got to the free trade and we're still pulling that 239 bucks out, we make 240 bucks in profit, gross profit on the whole trade, right? And again, round trip commission should cost you less than $6 or less. So the idea is that you still made money even though it really didn't fire like we had hoped. But guess what? And the second part went to a loss. This is why your win rate improves, right? Because if you just held it for the 5 days, you're down 26% on 975 bucks. You'd be down about 250 bucks or so, right? And you say, okay, instead we make 240 bucks because of the get your risk capital back first target, and then now giving it a chance to go. But if it doesn't, you're not sweating so much. So that's how you turn losers into winners as an options buyer, okay? So overall in the gross picture. So you look at that and say, sometimes we can't do exactly 2/3. Microsoft, there's another example where, hey, we weren't sweating that this reversal happened. This one, as you see, didn't actually really pan out in the big picture. We still made a touch of money on the trade, right? We bought it into that end of day, and the stock's trading about 427. We're buying the 430 strike calls, a few points out of the money. It snaps up just above 430 that next day. We paid 250, so thus we're able to buy 4 contracts for $1,000, so exactly $1,000. Again, grow before commission. And the idea is that, look, you see 3 contracts are sold because we can't sell 2 and get our risk capital back. So we sell 3 at the 50% gain the next trading day. Pops up to about 431. You might say, oh, this thing's going to rip even more to the upside. Let's not play the what if game. Let's just know that when you get to a 50% gain, you're going to take the money and run. That's what we do. And then look, the other piece of the day 5 tanks. It's down basically a wipeout, 96%. We get 10 cents out of it with another day or so to go before expiration, and you still make 135 bucks on the whole trade. Again, you hold it to the bitter end, you're looking at a wipeout of nearly right at about 960 bucks if you're selling all of it out at 10 cents. We get $135 total gross profit on the trade, despite that final contract essentially wiping out. So that's the beauty of this method, right? And now if it doesn't even get to the first target, we got to show you a losing example. These are going to happen from time to time. And it doesn't look that severe, but it shows you that, yeah, if it's just flatlining and you're not getting to the target. This is Bank America, another bank stock, 43 calls, a little bit out of the money. We only paid 38 cents for them. But those out of the monies, if they don't get firing into the strike price or so fairly quickly, you see that it just doesn't fire after a few days. We get stopped. Our 50% stop loss rule is in effect. That ends up being a $520 loss. So yeah, that can happen where you put $1,000 in, you can lose half of it or so on a given trade. And the point is that you want to be able to stomach that and know that you're not going to overreact. So of course, the final piece though is the big winner that's allowed to run. Let's look at one more. And we have no trailing stop loss on these. We give it a chance to run for the full 5 days. That's an important feature here. That's different than what most people would tell you. They're like, oh, you should always have a stop loss. Well, those are going to promote you getting whipsawed too much. So here's a Wells Fargo example to the upside where the stock just goes on and rips. And so you can see here that we had there's our setup. It's making that new high. It's actually closing at that new high. So we don't require it to either close at or not at that new high. We're just saying, look, it made it into the day. We're getting it with the other setups in place on the gap effects. You see we paid 59 cents for everybody. Get 16 contracts. We sell 11 of those 16 when it makes the 50% gain the next day. So it goes from about just slightly out of the money to slightly in the money. And we're saying, thanks very much. We'll take that risk-free trade. We've got 5 contracts left. Look at what those 5 contracts turn into. In at 59 cents, out at $4.85. That means you made over $400 a contract on 5 of those contracts, more than $2,000 on the final runner, if you will. We call these positions runner because look at that, 722%. It just goes ballistic on day 5, right? Up to $50.50. And you see $2,460 in gross profit on that particular Wells Fargo trade. So as a subscriber, you'll get real-time trade alerts, not just when to get in, but also, of course, the reminders when to get out, whether it's set up at a profit target or at a loss. We're going to never leave you hanging. So here's how you can get these. It's called 333 options. You get 3 months of trade alerts from us here. So, each of those months would usually cost you, in this case, $197 a month, or almost $600 for the 3 months. But look, we're going to give you that for a lot less today. You're going to get access also. I want the system to prove it to you. I don't want you to just take my word for it. Yeah, I've been in business here at Big Trends for 25 years in full next month. But I want you to see it for yourself and experience it for yourself. I've been blessed to serve tens of thousands of fellow traders. I want you to benefit from this and see it working for you too. So you get the settings and rule sheet. So like I said, that's huge. This is not a black box system. When you sign up, the terms of service say that's only for your use. You cannot share that, okay? We don't want to give away our edges to each and every person on the internet. So make sure to keep it for your benefit and your family's benefit. I think you'll be happy like fellow subscribers are. You also get weekly video training from me. I'm going to share with you what worked, what didn't. You know exactly what I'm looking at on each and every trade with a kind of a post-mortem, if you will, as well as what we're looking for going forward. And dedicated email to me and my research team. So if you've got questions, I've got fellow analysts backing me up as well. So we've got a great team here that's constantly scanning for these types of setups and sending them to you in real time whenever we get a new trade. The alert service itself is a $591 value. The access to me and my team, I would say, is almost priceless, but basically you'll get access to me too. But basically the idea is that, look, you're saving a bunch on today's special. I'm going to take that 3-month $591 value with all the extra trading resources and bonuses and support that me and my team give you, and I'm going to mark it down, scratch that $591 out, and mark it down today to just $177. And you say, well, why don't you make it a lot less? Well, think about it. One single trade on a $1,000 investment, I've showed you numerous examples that made you thousands potentially, right? I can't guarantee what the next trade is going to do. Your next trade can win or lose. You've got to look at this as a systematic, gradually taking money out of the market approach. The link we set up for you, thanks for posting that for me, Dave. It's members. It's not a www. Okay, so don't get confused with that. It's members.bigtrends.com/fest, F-E-S-T, because it really is a great kind of a fest to help take advantage of this. And I thank Dave as being a part of this festival here of fellow traders. But it's really all about, knowing that you're going to get on that member site a ton of educational resources too. So I want you thinking already like a Big Trends member of the 333 options program. So what that page looks like, by the way, when you go to it, I'll show you that real quick and then remind you the value of this, because you say, okay, look, let me see if I can pop that back up here real quick. That when you go to that page, here's what it looks like. And we keep our pages really simple. There it comes. Okay. So when you go to that page, we've already taken the discounts down. There's no other discounts to apply. The $177 gets you the 3-month alert service to 333 options. Like I said, over the course of each month, we expect 8 to 10 trades. So I'd say about 25 trades expected over the next 90 days to really guide you well into the end of the year and really position you well to start then saying, yeah, you'd like more of that in 2025. I think you're going to want to re-up. But there is no auto bill here. It's just a one-time investment of only $177 to let me and let the system, the 333 option system, prove it to you too. Okay, it's kind of one of those things like, okay, for $177, can you afford to find out that, yeah, you've been missing out on something all this time? And so you see, we've got this is a secure page, again, our 25th year serving our Big Trends community. Payment info up here. You can put your credit card information in there securely. See our 800 Big Trends number is shown up here too. If you've got any questions, call that, or you can also email our customer service team via clientcare@bigtrends.com. And we also have a PayPal link as you scroll down on that page, right? When you agree to the terms and conditions that are hyperlinked and spelled out, like I said, how we do business over these past 25 years and counting, we're all very transparent. But you see, the PayPal link is the way I do a lot of my online transactions. So bottom line is that whichever way you want to go, it's all right there. Discounts have already been applied. $591 is taken down to just $177, saving you 2/3 plus off of the usual $197 a month price. So like I said, go to that page, and like I said, $177. Remember what one trade can do for you, right? $2,406 gross profit on Apple on that trade, right? That was an extreme example. Usually a lot of these you've seen that might go up to the next remainder position, might double or triple or sometimes quadruple, and sometimes it might even flip on us, like we showed you with AMD, and turn into a loss and still make money on the trade. This will improve your win percentage as a straight options buyer. Like I said, the past history, went back to the beginning of last year through yesterday's close. I love how my team updates these to be current, is a $5,000 account grew to over $16,000 in gross in value, and over $11,000 in gross profit before commissions, before subscription investment. But like I said, what you see on a lot of these trades, you're dealing with just a few contracts at a time, and that can turn into a lot more. And the beauty of this is we don't recommend compounding it. We like the simple $1,000 a trade. And of course, as you're growing your portfolio, you can eventually scale it up, but don't go with a huge scale up. Remember also, past performance never guarantees future results. So like I said, I need to wrap it up here to make room for our next speaker. Go to that link right now, members.bigtrends.com/fest. If you got any questions, call us at 800-BIG-TRENDS or email us, clientcare@bigtrends.com. Thank you, Dave, for having me. It's always a pleasure, and look forward to hearing what your next fellow speakers have to share with our audience as well.